All right, today we are going to tackle what is, and I don't think this is an exaggeration, the single biggest tax benefit in the entire military pay system. We're talking about the combat pay exclusion. And we're not just scratching the surface here. We're going straight into the guts of the law, looking at Internal Revenue Code Section 112 and all the rules that make it tick. So let's get right into it.
So let's just start with a really simple but important question. If you had to pick one thing, just one, what do you think is the most significant, the most powerful tax benefit for a deployed U.S. service member? I mean, what's the one thing that can totally change the financial picture of a deployment?
And the answer is, you guessed it, the combat pay exclusion. It's all laid out in Internal Revenue Code Section 112. And listen, this isn't some minor deduction we're talking about, right? This is a massive tool. It can literally shield tens, sometimes even hundreds of thousands of dollars from federal income tax. So yeah, understanding exactly how this thing works, it's absolutely crucial.
Okay, so here's our game plan for this deep dive. We'll start with the law itself, Section 112. Then we'll get into the nitty-gritty Treasury regulations that actually put it to work. After that, we're going to decode that tricky officer cap, figure out what the IRS really means by a combat zone, and then we'll wrap it all up with the key planning takeaways you can actually use.
All right, first up, the law itself, Section 112. The most important thing to get right off the bat is that this whole thing is built on a two-tiered system. The law, right from the start, creates two totally different sets of rules. And what's the dividing line? A single factor, military rank. Seriously, this one split is the key to understanding everything else.
So here's that split in black and white. For enlisted personnel and warrant officers, you're looking at Section 112A. For them, the exclusion is total. It's uncapped. Every single dime of their compensation is sheltered. But, and this is a big but, for commissioned officers, Section 112B slams on the brakes. It imposes a very specific and kind of weird floating cap called the Maximum Enlisted Amount.
Let's actually look at the words from the law for enlisted members. It says gross income does not include compensation. Think about that phrasing. It's so absolute. It's not a deduction you take later. It's not a credit. The income is just gone. It's like it was never there for tax purposes. That is a profoundly powerful financial benefit.
Now, here's where it gets really interesting. There's this little definitional carve-out in Section 112CC1. The law goes out of its way to say that a commissioned warrant officer is not treated as a commissioned officer for this rule.
What does that mean?
It means even a super senior, highly paid Chief Warrant Officer 5, a CWO5, gets the exact same unlimited, uncapped exclusion as a brand new private. I mean, that is a massive, massive planning point.
Okay, so if the IRC, the Internal Revenue Code, tells us what the law is, think of it as the blueprint, then the Code of Federal Regulations, the CFR, tells us how to build a house. Specifically, we're looking at Section 1.1121. This is where the Treasury Department lays out all the operational rules for how this thing works in the real world.
And this right here, this might be the single most important rule in the whole regulation. It's the entitlement, not payment rule. The regs make it crystal clear. It doesn't matter when you get paid or where you are when the money hits your bank account. That's all irrelevant. The only thing that matters is when your entitlement to that pay was locked in. An entitlement happens the moment a service member does everything required to earn that money. This one concept, it opens the door to some major tax planning.
And check out these examples from the regulations themselves. They really show you how powerful this rule is. Say you submit an award-winning suggestion while you're in a combat zone. That award money is totally tax-free, even if they don't pay you until a year later. But here's the big one, the re-enlistment bonus. If you sign that multi-year contract while you're deployed, the entire bonus, and we're often talking tens of thousands of dollars, is completely shielded from federal tax. It doesn't matter if it's paid out months later when you're back home. That is a game changer.
The regulations also draw a really clear line in the sand. According to Section 1.112-1, only money paid directly by the armed forces qualifies for this exclusion. So think about a reservist who gets deployed. Their civilian job might pay them differential pay to make up for the lower military salary. Well, that money from the civilian employer, it's fully taxable. No way around it. This tax break is strictly for military compensation.
Okay, let's circle back to that limitation for our commissioned officers. We've got to break down exactly what this maximum enlisted amount is and how it's calculated, because it's not some number that's set in stone. It changes.
So, just to put a number on it, For the 2026 tax year, for example, here's the magic number: $11,391.90. Let that sink in. For any single month a commissioned officer serves in a combat zone, that's the absolute max they can exclude from their gross income.
So where does that number even come from? Well, the cap is actually the sum of two different things. First, you take the highest possible monthly basic pay for any enlisted member. That's going to be an E9 who's been in forever. Then, you add the full monthly amount of hostile fire or imminent danger pay. You add those two together, and boom, that's your cap for the year. Any pay an officer makes above that number in a given month, it's taxable.
Now, this is where it gets a little nuanced, but it's super important. That second part of the calculation, the hostile fire pay and imminent danger pay, they are not the same. IDP is all about geography. You get $7.50 for each day you're in a specific zone. It's prorated. HFP, though, that's totally different. It's triggered by an event. If you are shot at just one time on one day, you get the full, non-prorated $225 for the entire month. And that little difference can have a big impact on an officer's maximum exclusion.
You know, we've been throwing around the term "in a combat zone" a lot, but what does that legally even mean? It's not just a casual term for a dangerous place. For tax purposes, an area has to qualify through one of three very specific legal pathways.
And here are those three pathways. The first and most common way is when the president issues an executive order. Simple as that. The second way is when Congress steps in and passes a public law to create something called a Qualified Hazardous Duty Area, a QHDA. It gets the exact same tax treatment. And the third way is when the Department of Defense certifies its service in a nearby area is in direct support of those combat operations.
Now, that third one, the direct support pathway, it's got a catch. It's a two-part test, and you have to meet both. First, the DoD has to officially certify the area. And second, the service member has to actually be receiving hostile fire or imminent danger pay. So just being nearby providing logistical support from a totally safe spot isn't going to cut it. The tax benefit is tied directly to the member being in a situation of real peril.
Okay, that was a lot of legal and regulatory detail, I know. So let's pull it all together. What does this all mean in practice? Let's talk about the most important planning strategies that you absolutely need to know.
All right, here are your key action points. Number 1, timing is everything. That entitlement rule we talked about means that signing a re-enlistment contract during a combat zone month can shield a massive bonus from taxes. Number 2, for officers, you have to track their pay month by month against that changing cap. Number 3, remember the difference between HFP and IDP. For an officer, a single hostile fire pay event is way more valuable, tax-wise, than just a few days of imminent danger pay. And finally, don't sleep on that special election for the Earned Income Tax Credit. It allows some members to actually use their non-taxable combat pay just to get a bigger tax refund.
So I'll leave you with this final thought to chew on. When you really think about it, when you combine that unlimited exclusion for enlisted folks with that incredibly powerful entitlement rule from the regulations, does that make the simple act of timing a re-enlistment bonus the single most powerful tax planning tool in the entire military pay system? I mean, it's a strategy that can put a 5- or even 6-figure bonus into a service member's pocket, completely untouched by the IRS, all thanks to the rules we've just deconstructed. Something to think about. Thanks for joining it.